Hello and welcome to Switzer Investing. I'm Peter Switzer, and this week I'm coming from sunny blue sky Port Douglas. That's why I'm not wearing a coat. On the program tonight, we've got Julia Lee on why the market keeps rising despite all of these headwinds of wars and rising petrol prices, inflation and interest rates on the rise. All those things should be heard in the stock market, but March has been a great month for stocks. We'll find out why with Julia Lee. And poor Rickard has a look at Magellan. Is it in the buy zone? This was a $60 stock a year or so ago, and now it's $14. It's fallen at least three major drops on the market. Often three is enough before you start buying. Let's see if poor Rickard thinks it's time to get in there and buying Magellan again. And then Michael Knox of Morgan's, the chief economist there, he's really good at picking the Aussie dollar. So I've got him to give us his latest outlook for the Aussie dollar. Is it going to keep on rising? If so, you need to consider that when you're investing. And also on interest rates, will the Australian situation follow the American one? The Americans are talking about 7 or even 10 interest rate rises. Could that put pressure on us? I've got Michael Knox covering that particularly important topic. So let's kick off with Julia Lee of Berman Invest. Thanks for joining us, Julia.
Great to be here, Pete.
All right, Julia, one question I keep getting all the time is, with so many headwinds out there with the Ukraine war rising, petrol prices, a budget to come, an election to come, inflation, interest rate rising, how come the stock market is on the rise again?
It's actually been a fantastic time for the market this month. We're on track for the best monthly gain in 17 months. And the last 5 sessions, all 5, have seen a positive return for the market. I guess it's been a bit of a roller coaster ride this year, though. In January, the market was down 6.5%, February up a bit, and then in March, we've seen a bounce back. So the year's pretty flat. And I guess the main concern that investors have at the moment is around inflation. And inflation is really just the value of your cash melting away. And if you think about what you want to do to protect the value of your assets in an inflationary environment, you want to either probably be looking at real assets like commodities, which have been performing extremely well, or you want to find investments which are growing faster than the pace of inflation. So I think at the moment, the market's being focused very much on rising interest rates, and it's hit things like the tech sector, the property sector, infrastructure extremely hard. But I feel like, Pete, that it's a case of the baby being thrown out with the bathwater, because there are still companies in that sector growing very strongly and profitable. And of course, in a rising interest rate environment and an inflationary environment, you do want companies that are growing strongly and profitable as well.
Yeah, one of the things you said last week, which a lot of people were interested in, when you said tech is starting to look interesting, which is Julia Lee code for, I might be buying some. Did you buy any tech stocks last week?
Yeah, I think zero under $100, which is back at today, is looking very interesting. And look, I think a fair value is more around that $120 mark. And look, some of its competitors are upping their game overseas. Over in the US, we're seeing Intuit allowing its customers to do projects and mail outs through MailChimp. But altogether, things have been still relatively strong from a growth perspective. I'm watching the budget to see whether there are extra incentives for innovation and new companies here in Australia. So the next 24 hours, I think, is going to be important. But of course, the reason why shares are being sold down so heavily in that tech sector is around rising interest rates. Today, Pete, in the 3-year Australian bond yield space, we saw it reaching the highest level that was seen in 2014. And of course, over in the US, we're seeing worse. The next month, the market pricing in a 50 basis point rise in interest rates over in the US. And look, of course, in that type of environment, you're going to see commodities doing relatively well, which we have. BHP is up another 2.6% today. Iron ore prices are above 150 US a ton. The banks, usually they reprice their mortgage books upwards, and the banks were all positive today, and insurers as well. They usually make a greater yield from their investment income, which is usually invested in things like US bonds and Australian bonds.
Yeah, you have liked miners of late. You're not always a person who invests in miners, but of late you have been. Are you still with the mining sector?
Yes, still with the mining sector, BHP Billiton has been doing well. We still have Woodside, even though we've decreased our stake and almost halved and taken profits in Woodside now. And the reason behind that is that while the war between Ukraine and Russia is still elevating energy prices and uncertainty around energy, in actual fact, Pete, it costs less than 50 US a barrel to get oil out of the ground. And at the moment, we're seeing it at about 110 US a barrel. We have seen oil prices taking a bit of a step back today, and that's because of the COVID situation in China. We've seen half of Shanghai being locked down. And of course, when you're in lockdown, you're usually not driving, so that impacts on oil demand. So watching China's situation very closely. But on the flip side, we've seen iron ore prices up a huge 5.5% today, and that's really helping fuel the rally in BHP, Rio, as well as Fortescue. So we have BHP, Woodside Petroleum, and not really in that mining space, but somewhat related is Incitec Pivot, which is above $4 at the moment. And I've been a fan of fertilizer for a while. And one of the major costs of fertilizer is energy prices. So as oil prices rise, usually see fertilizer prices rising.
Okay. So one last thing, if you had to, lay out the year ahead for investing, do you suspect ultimately, I'm suspecting a peace talk will eventually result, that will probably drive down oil prices, which would be good for fighting those people thinking a recession is coming. On balance, do you think we'll muddle through this and probably end up higher at the end of this year?
Yeah, I think the earnings picture is still looking relatively strong. I think in a rising interest rate environment, you still want to be overweight to the financial space as well as the insurance sector. And look, I think commodities will continue to do well. I think oil prices at 110, 120 US a barrel, happy to take some profits and money off the table here. But in terms of iron ore, remember China has a different interest rate cycle to the US and Australia. And at a time when the US is looking at hiking interest rates, China's really cutting interest rates and stimulating its economy, and usually it does that through building things, which should be supportive of iron ore in the short term.
Julia, thanks for joining us.
Thanks, Pete.
Joining me now is Paul Rickard in the studio while I'm up in sunny Port Douglas. Paul, how are you going?
I'm doing well, Peter. Someone has to be here.
Exactly. I'm glad it's you and not me. Now, mate, let's go to a really important company that's really struggled even before the new year. It's been on the way down for quite some time. It was around nearly $60 in the middle of last year, but gee, it's been sliding. It's Magellan today around $14. What's going on there, Paul? And is it in recovery mode yet?
Well, fundamentally, Peter, it's a story about performance. That is the market and a number of Magellan's investors have realised that it's underperforming its key index. It has been doing so for some time, and this is what happens to fund managers when you start to underperform. Eventually, the money moves out, and that sort of creates its own problems. But of course, that means future earnings are going to be lower. Now, there's some other things also going on with Magellan, which of course haven't helped, and we've seen the loss of a CEO back in November, December last year. Had a very public sort of separation with Hamish Douglas and his partner. That was rather messy, and of course that caused consternations amongst shareholders. And then finally, we've had some other challenges with Magellan. They were seen to be investing a little bit outside their knitting. In other words, they took a stake in a fast food chain. They helped fund Barrenjoey, which is one of the investment banks, and they got most of the broking market offside with that. So all these sort of things have come together, and we've seen the share price come from about $60 down to about $14, Peter. So it's been a massive fall from grace. They lost a major client, St James's Palace in the UK. All these things happened, but fundamentally, putting all that together, still it's largely, as I would say, with most fund managers, they're great when they're performing, and when they start not to perform, eventually the market gets attuned to that, and of course we see funds outflow and the share price sort of follows.
What's going to be needed, Paul, to change the attitude of the analysts who are still negative on the company, aren't they?
Yeah, the analysts have got even more negative, Peter. In fact, they've followed it down a little bit. And the analysts are now still have a consensus target price, which is below the Magellan share price. So Magellan's about $14. The analysts have a consensus of $13.50. And they're worried that you're going to see a lot more funds outflow or funds under management moving out of the company, and that's going to affect future earnings. So they've gone a bit negative. So what can turn it around, Peter, is fundamentally the new management team under Chris Mackay. Chris, of course, made his name originally with Hamish, left the company, has come back. They need to really start to turn the performance around. It doesn't have to be a miracle, but it does have to get back onto a kilter, at least perform along with the index. And if they can stabilise the investment performance, then the funds will stabilise and people will start to see value. So on a value sense, Magellan is super cheap, Peter. It's trading on a price earnings multiple of about 6.6 times this year's earnings, and even allowing for a big fall in earnings next year because people have seen the funds have flowed out, it's still only about just under 10 times. So it's really cheap. There's no argument that Magellan is a value stock, but I still think there's maybe more bad news to come and the market's going to react negatively. And so until you see the investment performance back on track, I think it's a watch and wait stock.
Okay, so that's the problem for anyone who's a shareholder of Magellan. But what if you've just invested your money in one of Magellan's funds? Are you necessarily in the same difficult predicament?
Well, I think you want the same outcome. That is, you really want performance to improve. So I guess in some sense the predicament is a little similar, Peter, not quite the same, but you ultimately want Chris Mackay and the investment team at Magellan to get their mojo back a little bit. They don't have to outperform, but they have to at least get back to sort of close to market. And so both shareholders and investors, that is investors in one of their managed funds, really want the same outcome.
Okay, so one thing I will say, they've had at least 3 legs down. That's often enough to turn a company's fortunes around. Do you think there's going to be a fourth?
Look, hard to call, Peter. I mean, we always warn people about catching the falling knife, and sometimes these things keep falling. And I think, I could have made the same argument that Magellan would look pretty valuable at $20, and it did, but it's now 14. I was a bit surprised that the market was as negative after Magellan's last funds under management report. So every month they tell the market about the volume of funds they've got under management. And I thought it was always obvious you're going to see funds outflows, and the market took it rather negatively. So we're going to see another report round about the 14th of April when they'll update the market for what happened to their funds under management during March. At the same time, about that date, they'll also tell us how they performed during March. And that might give another sort of leg one way or the other of the share price. But look, I'm always a bit wary because there hasn't been any bottom. I mean, today's price is the lowest it's been, or round about the lowest it's been. There's no sign yet, Peter, that it's actually, has hit the bottom. And I think, to go back to that sort of falling knife analogy, when we see a stock in that situation, experience tells us to be super patient, wait for it to bottom before you get on. So I'd be a little bit cautious trying to just run and say Magellan's super cheap, it's going to turn around. I think this is an easy company to see that it is turning around, and all you've got to look for is just look at how it's performing as a funds manager.
Okay, mate. Thanks for joining us. It's a very good analysis. Paul Rickard of the Switzer Report.
Thanks, Peter.
Well, joining us now from Morgan's, the Chief Economist, is Michael Knox. Michael, thanks for joining us.
Always great to talk to you, Peter.
Mate, a lot of people would be wondering, how come if we've got a Ukraine war on, we've got rising inflation, rising interest rates in the US, we're talking about a 50 basis point rise next month, and you've got even talk of a US recession out there waiting to happen. How come stocks are rising right now?
Well, the economy is still really, really good. In the US, we're at the US is at full employment. The number of jobless claims was the lowest in the last month since the 1960s. Unemployment is expected in the US, according to the Fed, to fall to 3.5% this year, which is the lowest since 1968. And growth is still maybe not as strong as they were, as they thought last year, but just below 3% this year and next year. And that's twice as fast as the average growth rate, almost twice as fast as the average growth rate, US economy. The growth rate of the US economy that the Fed thinks they'll achieve in the long term is about 1.8%. And this year they think it'll be just below 3, about 2.8%. So it's still a very strong US economy. Still earnings, still very good earnings.
So, Michael, do you think that, talk of recession this year in the US is baloney?
The discussion of recession seems to be because of discussion of the flattening of the yield curve, particularly the 2s and the 10s, the 2-year bonds and the 10-year bonds. But as I've been pointing out in a series of presentations I've been doing to institutional clients over the last week or so, there is another measure of the shape of the yield curve, and that is 90-day bills and 10-year bonds. Actually, there's a number of them, but that's the one I use. Yeah. And only if both of those invert at the same time is there a recession. And it is absolutely, definitely not the case that the yield curve between the 90 days and the 10 years it's very strongly positive. It's not inverting at all. Yeah. And in fact, there was one time back in the end of the 1990s where the 2s and 10s were almost flat for 5 years, from 1995 through to 2000, and still no recession occurred until 2000. And there was a very soft recession when it happened.
Yeah, bond markets do, they can be good, but they also do have a lot of baloney there. But let's not pick on bond market people. Let's go to the currency now. A lot of people keep asking me what's happened to the Aussie dollar. I know with our financial planning clients, we put them in IHVV and the hedging has worked partly on your best guess.
So it's all my fault. Thank you, Peter.
Well, we've gained at least. I'm ticking you for that. But do you think this $8 rise will keep going?
Yeah, well, the Aussie dollar and the Canadian dollar are both beneficiaries from the unfortunate events in Ukraine, because what happens in Ukraine, both in Ukraine and in Russia, it's enormously damaged the international wheat supply. Ukraine is the 5th largest exporter of wheat in the world, and Australia is the 6th largest exporter of wheat in the world, for example. And Canada is a big exporter of wheat and oil, and we are a big exporter of wheat and LNG, liquefied natural gas. And both of those are in short supply because of the war in Ukraine. And so for both of our currencies have benefited. But what I've said about this before is I think that the rally in the Aussie dollar, which I think is reasonable to expect, happens because of a general fall in the US dollar against a number of currencies. And I don't believe that that's begun yet. I think if you look at measures like the SDR, the IMF basket, which is XDR USD. If you look at a chart of that, it's still lower, and the US trade weighted index is still higher. Now, I think we've said in a previous discussion that there was a bubble in the US dollar at the moment, and I think we said previously that one of the explanations for that, the one that was presented by Bill Dudley when he was asked about this last year on Bloomberg, was that he thought it was either quantitative easing or inflationary expectations in the US dollar hadn't been fully realised. You know, how inflation, the high level of inflation, hadn't yet been incorporated into the bond market. And well, here we are. The Fed has brought bringing quantitative easing to an end. So if it's the Fed buying US Treasury bonds, and then that's going to unwind pretty smartly. But it hasn't unwound yet. So,
Okay.
so
you're saying that there is a potential for the US dollar to fall more, which of course will probably help ours go up. You've also added in the past, I think the big budget deficit in the US often drives the US dollar down as well. And also, if you believe your scenario about lots of growth out there, that also should help, exporters like Australia as well, shouldn't it?
yes, all of that is the case. So the answer, Peter, is yes. I'm very optimistic about the US dollar, but right now it's up against a bit of historic resistance at 75.5 cents. It needs to be able to break through that, and I think probably in the next couple of weeks, my best guess is it won't be able to do it right now. It'll come off a bit, but it'll be able to do it later sometime this year.
And you did say US dollar, you're a fan of the Aussie dollar. Aussie dollar up, US dollar down, is that right?
Yeah, and well, also not just the Australian dollar, but also the Canadian dollar, because the Canadian dollar is Canada is a big exporter of wheat and energy, both of which will be in short supply about what's happening in Ukraine, and so are we.
All right, now, Loxy, some people will be looking at the problems in Europe and saying, well, if peace talks eventually happen, a lot of European companies that have come off the boil because of the fears around the Ukraine-Russian war, they'll probably have a stock market rebound. And I've often said to those people, but you've got to be careful about the currency, because one of my best trades of all time was buying the Triple Q after the dot-com bust. The Triple Q rebounded like nobody's business, but so did the Aussie dollar. So all my gains was, in a sense, were wiped out by the gains in the Aussie dollar. What is your view on Aussie dollar versus euro going forward?
Well, I think we'll outperform most exchange rates. Right now, our model, as the Aussie dollar has gone up this little way from about 70 cents US to about 75 cents US, in terms of our model of the Aussie dollar, which is famously bullish, it's moved from 3 standard errors too cheap to 2.7 standard errors too cheap. So I think that the Aussie and the Canadian dollar are both very strong against pretty much all comers over the next couple of years. And I think we'll outperform the euro. Yeah, I think the euro will go up against the US dollar, but I think we'll outperform. That's for sure.
Yeah, right. So one last question, it's related to probably both. How aggressive do you think the Fed's going to be? And then how aggressive do you think Dr. Phil Lowe, not Dr. Phil, as you made the point last time?
Mr. Philip Lowe, PhD, in fact.
That's right. I said last time, yes. Your ear and told you, tell Switzer to stop calling me Dr. Phil. So just give us your Fed view, then what you think the RBA will do here.
Well, I think both central banks are in entirely different circumstances because inflation is completely different. And the reason inflation is completely different is because the US budget deficit was much, twice as large as ours, twice as much deficit stimulus, particularly the deficit stimulus last year. I've done a little podcast in which I've suggested that the deficit stimulus last year in the US added 10.5% to the level of US inflation. So it's a major structural problem, that budget deficit too big. So therefore, what the Fed has to do is much more aggressive than what we have to do. I've, in my most recently updated model of the Fed funds rate, I've thought, my target for the Fed funds rate at the end of the year was 190 points, and the consensus with the dot plots, the Fed members was 189 basis points. So I thought that's right, pretty much it. Yeah, so the Fed funds goes up 2% this year. But the other thing that Jay Powell has said is that when we read the minutes of this meeting that's just passed, what we realised is there was a very detailed discussion of the beginning of reducing the size of the balance sheet, and I think that the effect of QE on keeping interest rates low particularly things like US mortgages. Remember, the Fed wasn't just buying US Treasury bonds, it was buying mortgages.
Yeah.
Now we've seen the Fed has stopped buying mortgages as well as US Treasuries, and we've seen quite dramatic increases in US Treasuries and US mortgages. I mean, US mortgages, 20-year mortgages, are up almost 2%. I mean, the Fed might have only gone up 25 basis points with the rate hike, but mortgage rates in the US are up almost 2% since the beginning of the year. So I think that tightening of mortgage rates will be much, much more aggressive than what you see the Fed do. And that's why I think it's really going to put the brakes on the US economy as we move particularly into next year.
Okay, so
Australia, we're only putting up short rates. I think inflation, that core inflation in the trimmed mean in Australia, the last measure was only 2.6%, and Mr. Philip Lowe, PhD, pointed out that in 5 years we've only just now hit our inflation target for the first time. So I don't think he has to move. I think he'll start moving in the second half of the year rather than the first half of the year.
Yeah.
But what's really important, I think, in the currency market is what's happening at the long end. And our bond yields are a full 70 basis points higher for 10-year bonds than the US is. And I think that's what the international market will be our bonds rather than the short rates.
Great stuff, Mike. Thanks for joining us.
Thank you, Peter.
Michael Knox, Chief Economist at Morgans. And that was Michael Knox of Morgans. Thanks for joining us. And don't forget, we're here on Thursday. And if you want to know more about the stocks we like from my experts, my team of experts, go to switzerreport.com.au. Thanks for joining me. See you on Thursday.